The National Housing Conference in the U.S. highlights two main problems causing the housing crisis. First, there is a long-standing lack of affordable homes for many working Americans, leading to high housing costs and homelessness. Second, there has been a significant drop in home ownership among African Americans. How the country tackles these issues will shape its future, both in the next recession and for many years ahead. Today, we'll explore the housing crisis seen in the U.S. and why being a homeowner today is becoming a struggle. The housing problem in the United States is becoming worse. A 2023 Urban Institute study found that 12% of the city's over 82,000 citizens of Washington, D.C. do not have stable housing. People of color make up the majority of those experiencing housing instability, a trend observed across the country. The Biden administration has taken action in response to this issue, realizing its gravity and how it affects Americans' faith in the economy. In March, the administration introduced new policies, combining public and private efforts. These policies aim to reform exclusionary zoning, expand affordable housing financing, and convert empty office spaces into apartments. But why is there a housing crisis in the United States in the first place? What drove the market to a problematic state? Well, there are a number of factors we can explore. The first issue is the imbalance between supply and demand in the housing market. Bankrate, a financial services company, reported that the National Association of Realtors revealed that the number of homes available for purchase in the United States reached a record low of just 1.6 months in January 2022. Although this has improved, it's still far from meeting demand. The shortage of homes has gotten worse due to factors like rising material costs, issues with the supply chain, and COVID-related labor shortages. But this problem predated the pandemic, as the United States has had difficulty meeting the housing demands of an expanding population. In addition to the scarcity of resources, the Great Recession of 2007-2008 also played a role, with lingering consequences. The St. Louis Fed's data indicates that the housing supply decreased during the recession. Construction of new homes increased in 2005, reaching a peak of more than 2,200 units in January 2006. But this figure fell sharply, with just 478 units recorded in April 2009. The number hasn't reached pre-recession levels despite a gradual increase since then, reaching 1,521 units in February 2024. Additionally, zoning regulations and other obstacles make it costly and challenging to build new homes. The Brookings Institution found that in most U.S. cities, local zoning rules only allow single-family detached houses on 3/4 of the land. This means townhouses, duplexes, and apartment buildings are often not permitted. Even where multifamily buildings are allowed, restrictions like building height limits and minimum lot sizes often make new developments financially unfeasible. As a result, the shortage of housing options leads to a highly competitive market where many buyers compete for a limited number of properties. This often causes bidding wars and increases home prices. According to a Redfin study, the typical U.S. household could afford only 15.5% of home listings in 2023. Because sellers have access to alternative interested buyers who are prepared to forego contingencies and accept fewer appealing conditions, buyers are also left with less authority and protection during deals. The second reason for the housing crisis is investor activity. Institutional investors purchase homes to flip or rent out for profit. During a background press call, senior administration officials discussed efforts to make rent more affordable for Americans. They highlighted that in cities like Las Vegas, investors buy homes with cash, convert them into rentals, and then raise the rents. Some corporate landlords are increasing rents by more than their costs, boosting their profits while millions of Americans struggle to pay rent each month. Realtor.com revealed that investors are now more often in competition with buyers than with sellers. Although the proportion of houses purchased by investors is traditionally significant, since late 2022, the gap between their purchases and sales has shrunk. Investor acquisitions have continuously exceeded their sales since September 2020, reaching a peak in June 2022 when they purchased around 13,000 more properties than they sold. High rental prices in the summer of 2022 probably contributed to this spike by incentivizing investors to rent out rather than sell their properties. The appeal of renting out homes has decreased as rent growth has slowed, which has resulted in a reduction in investor sales and purchases. The third reason for the housing problem in the United States is rising costs. The cost of materials and labor for construction has gone up due to inflation and supply chain issues. Additionally, higher interest rates make buying a home more expensive, reducing affordability. Redfin reports that the median U.S. home sale price rose to $394,000 in the 4 weeks ending June 9th this year, a 4.4% increase from the previous year. With a median interest rate of 6.99% for a 30-year mortgage, the monthly payment at that price is now $2,829, just $30 short of April's record. Over the past 3 years, higher mortgage rates have created a golden handcuff effect. Sellers who secured record-low mortgage rates of 3% or less during the pandemic are hesitant to sell, further limiting supply and leaving fewer options for potential buyers. Julie Hollinshead, a finance professor at Wayne State University, explained to Fox 2 that there's a big difference in home ownership rates between baby boomers and younger generations like millennials and Gen Z. Citing Redfin, about 45% of baby boomers own their homes, while only 12% of millennials do. She noted that younger people often live with those who own homes instead. She says, home prices have increased 300% since 1980. What that means is, if you are a millennial or a Gen Z, it takes a lot more money for that down payment, not to mention the monthly mortgage payments. With the housing crisis continuing to persist, it's already a no-brainer that buying a house back then could be considered easier than buying one today. But why is that? Let's look into some of the factors. Number one is obvious: affordability. The income needed to afford a typical home is increasing at its fastest rate in over 15 years, according to Adam Data Solutions' first quarter 2022 report. Cited by the National Association of Realtors, home affordability has declined in nearly 80% of the markets tracked, as both home prices and mortgage rates continue to rise. Additionally, the costs for purchasing a house are climbing faster than wages across most of the country. Over the past decade, prices in the U.S. have surged 74%, while average wages have increased only 54%. In states like Texas, Florida, and much of the western U.S., home prices have risen more than twice as fast as wages. For instance, in Nevada, although earnings grew by only 47% between 2010 and 2022, housing costs increased by 162%. Wages and house prices have closely increased together since 1990, but in states like Colorado and Oregon, property values have surpassed wage growth. The second factor is the difficulty in finding starter homes. For those who have no idea what that is, these are small houses ideal for first-time buyers. These homes are becoming harder to find due to high demand and a shortage of affordable housing. With the ongoing housing shortage, rising prices, high mortgage rates, and homeowners with low locked-in rates staying put longer, the challenge of finding affordable homes keeps getting tougher. According to Realtor.com, the supply of starter homes is shrinking and prices are rising. In 2019, the median price for a starter home was just under $220,000, requiring about a $49,000 household income. By 2022, the same type of home was listed at $325,000, a 48% increase. The price for such homes was relatively low 10 years ago, and it's expected to keep rising in the future. Real estate investors are targeting starter homes, making the issue worse. According to Redfin data, investors accounted for 19% of all home purchases in the first quarter of 2024, the highest percentage in more than 2 years. It is more difficult for buyers who require loans to compete against these all-cash bids because investors frequently possess the funds to purchase starter houses entirely. A third reason why buying a house was easier in the past is that mortgage requirements are now stricter. Lenders now have tougher standards for verifying income. They closely examine the borrower's income to ensure they can repay the loan. Stated income or low documentation loans are no longer available, which creates problems for self-employed borrowers. Additionally, people who are paid in cash, such as those in the restaurant industry, may also face difficulties getting approved due to lenders' concerns about cash deposits. Also, clients need to exercise caution when it comes to their credit scores now more than ever. They must inform the lender of any action that affects their credit score. Borrowers should refrain from creating new accounts, skipping payments, making big purchases, and canceling credit card accounts in order to guarantee mortgage approval. And just before closing, lenders will review borrowers' credit records once more, and any modifications made after the first application might cause issues. But there are also several other factors that contribute to the current housing difficulties. Many millennials are burdened with student loan debt, with the Pew Research Center noting that the number of households with student loan debt doubled from 1998 to 2016. Millennials have a median debt of $19,000 compared to $12,800 for Gen Xers. Another factor worth mentioning is that marriage isn't as much of a priority for millennials. In 1960, people typically married in their early 20s, but today, the average age of first marriage is in the late 20s, with most men not marrying until at least 29. The Urban Institute reports that being married increases the likelihood of homeownership by 18 percentage points. If marriage rates in 2015 were the same as in 1990, millennial homeownership would be 5% higher. The U.S. is tackling the housing crisis with a multi-pronged approach, both statewide and nationwide. Let's look at how the country is approaching the problem. With competition intensifying and housing supply dwindling, cities are reevaluating their zoning rules, which dictate where and what can be built. Many cities are discovering that their outdated rules are too strict, making it difficult and costly to build new homes. To address this, some states are starting a process known as zoning reform. They are creating new rules to allow multifamily homes in more areas, encourage higher density near public transit, and simplify the permitting process for builders. Minneapolis is a prime example when it comes to modifying its zoning rules. The city allowed more density in downtown areas and along transit routes, removed parking requirements, and permitted accessory dwelling units, or ADUs, which are extra homes on the same lot. One notable change was ending single-family zoning, allowing 2- and 3-unit homes in all neighborhoods. According to researchers at the Pew Charitable Trusts, from 2017 to 2022, nearly 21,000 new housing units were approved in Minneapolis. Most of these were in large buildings with 20 or more units, while only 1% were in smaller buildings with 2 to 4 units. Thanks to these changes, Minneapolis significantly increased its housing supply and kept rent growth low. During this period, the city's housing stock grew by 12%, while rents increased by only 1%. Another way the U.S. is tackling the limited supply problem is the Biden-Harris administration's Housing Supply Action Plan, where everyone has access to a safe and affordable home. It aims to boost the construction of affordable rental units and incentivize development in areas with high housing needs. It seeks to lower costs by building and preserving more housing, especially for lower and middle-income families. In addition, the strategy aims to lower barriers such as zoning and land use restrictions, increase finance for low-cost, energy-efficient houses, and encourage the conversion of commercial spaces into residential ones, especially for low-cost, zero-emission housing. Besides increasing housing supply, offering financial aid to renters and buyers can also help solve the housing crisis. Programs like housing vouchers and down payment assistance support low-income renters and first-time buyers in covering rent or making a down payment. For instance, during the COVID-19 pandemic, many low-income citizens were at higher risk because crowded and unstable housing made it harder to practice social distancing. The response to these housing needs was slow and insufficient. Since funding for rental assistance programs is limited and doesn't automatically grow with demand, many households had to wait for emergency rental assistance measures to be put in place. The March 2020 CARES Act offered some rental aid at first. However, substantial funds for emergency rental assistance were not allocated until late December 2020, more than 9 months after the start of serious job losses, until the American Rescue Plan Act of March 2021 added more funding. For many tenants, this support is essential in helping them pay off their outstanding payments, pay for their future rent and utilities, and prevent being evicted when their moratoriums expire. Though this may be considered as a band-aid solution for being unable to afford rent, it's still a start. And speaking of renters, protecting them is also a solution being done by some parts of the country. To protect them, some states and local areas are putting new measures in place. These include rent control laws and just because eviction rules, which limit the reasons a landlord can use to evict a tenant. The National Low-Income Housing Coalition reported in 2022 that 31 states and 66 localities have enacted over 150 new laws and policies since January 2021 to safeguard tenants and ensure stable housing. These protective measures, together with emergency rental assistance programs, helped prevent almost 1.36 million evictions in 2021, according to a report from the Eviction Lab. The number of renters facing eviction increased due to the pandemic's economic effects. Although in 2021, the number of evictions was only half of the historical average. But as people in authority move pieces in the government and economy to alleviate some of the housing struggles in the country, the citizens themselves have become creative when it comes to coping with the crisis. People have shifted their living arrangements as one of the many ways citizens have been dealing with the housing dilemma in the U.S. House sharing, or co-living, is becoming increasingly popular in the U.S. as a budget-friendly alternative to high rental prices. Even Forbes has noted its growing trend. Many co-living companies are now teaming up with homeowners to rent out properties for shared housing arrangements. Additionally, an increasing number of people are choosing to live in multi-generational households, where different generations, including adults and grandparents, live together to share costs and childcare duties. In March 2021, about 59.7 million people in the U.S. were living in homes with multiple generations, up from 58.4 million in 2019, according to Pew Research Center's analysis of census data. In 2021, 18% of the U.S. population lived in multi-generational households. Some co-live with strangers, others live with their extended families. But there's also a large number of people who opted for or were forced into vehicular homelessness. As seen in the LAist, the number of cars utilized as homes increased 16%, while the number of vans increased 44% in Los Angeles County. According to the region's 2023 count, over 14,000 homeless persons lived in vehicles and RVs. This trend isn't limited to LA. Many people experiencing homelessness, especially in West Coast cities, live in vehicles. Transfers magazine estimates that 17% of homeless people in San Jose, California, 19% in Seattle and King County, Washington, and 29% in Sonoma County, California, are living in vehicles. By mid-2022, there were over 3 million van lifers in the United States. There's also opting to downsize or move into a tiny home, as it offers a more minimalist and potentially more affordable housing option, though local regulations can vary. North America is experiencing rapid growth in the tiny home market, with the US and Canada leading in purchases. According to ER Marketing, the tiny house market grew by $3.57 billion from 2021 to 2026, showing a compound annual growth rate of 4.45% and a year-over-year growth of 3.88%. And it's not just housing adjustments. Citizens are also modifying their financial practices to keep up with the crisis. People began to pursue side hustles such as part-time work in order to boost their income and cover housing costs. Others choose to postpone homeownership because of affordability issues. Therefore, some people choose to rent longer or live with relatives until the market stabilizes. Whether it's the skyrocketing material costs due to inflation or huge private investors buying up houses, it is no secret that having a place of your own is becoming increasingly difficult as the years go by. Even paying rent is getting harder with each passing decade. Is it time to consider tiny house living? Or is this a great opportunity to pack everything up, start van life, and travel across the country? Whatever the choice, citizens continue to be creative and resilient amidst the country's housing crisis. Thank you for watching.